crazy. I think I'm going to go ahead and get started, and we'll let people join as they may. But welcome to another monthly agent meeting. It's always really good to see your faces via the camera. I wish it were in person, but maybe someday soon. Okay, we have a semi-hefty intro that I'm really excited about everyone talking before we get to Mark. First, I want to introduce you to Meredith. Meredith, forgive me if I'm about to botch your last name. Iacoca? Is it something like that? Okay, Meredith Iacoca, she runs Abundant Plate Wellness, and I'm gonna let her kind of take over and give her a brief intro and explain why she thinks you guys should know about her. So, Meredith, take it away. Meredith, you're muted.
There we go. Sorry.
There you go.
I apologize if there's background noise. I'm in my kitchen, so forgive me. But yeah, it's nice to meet you guys. I'm really glad I could pop on here and maybe explain why the heck I feel like we should know each other. So my business is called Abundant Plate Wellness, and I am a kind of a specialty meal prep and catering company. I specialize in gluten and dairy-free meals. And I do catering as well. So I really cater to people that have food sensitivities, because it's kind of just an underlooked area in food. So I think both of us as businesses, as realtors, you guys provide a very basic need that is so important, housing. And I provide a very basic need, food. So I see a lot of similarities in our business. We're both creating relationships with customers or clients to make them feel like they trust us, like we're providing a service to them that's helping them and really providing more quality to their life. And it's kind of it's a big decision, whether that's a house or food for your family. So that's why I kind of wanted to connect with you guys and just be a resource and a tool that you guys can have in your toolbox. I know often you buy meals for clients when they move in, like there's nothing better than a homemade meal when you've just moved in and you don't know where to go or anything like that. So I think food can help strengthen that relationship between client and realtor. But also for you guys as business people, nourishing yourself is kind of the most basic need. And when we nourish ourselves, we can nourish others. And it's kind of just this cyclical circle that returns to you tenfold. So whether that's you need lunches for business meetings or for yourself or for your family, I think there's a lot of room there that I could provide help. So I just wanted to introduce myself, say hi. I'm bringing some treats in to your office on Monday. And then I will follow up with Rosie and give a little link if you guys want to look on my website. My website is abundantplatewellness.com. I have menus every week. So, and they change every week. So you order by Wednesday and you get food on Sunday. So you can look at the menu, you can see what I have, and see if that applies to you or someone that you know that does. So yeah, I thank you guys so much. Thanks for letting me pop on here. I'm sorry we couldn't meet in person, but I totally get it. It's unpredictable this week. So
for sure. Meredith, thank you so much. It's such a treat to have you. Yeah, guys, I thought this would just be helpful because I know sometimes you guys are looking for great closing gifts or even like client care after you've helped someone buy a house and they're going through a rough time. I know I'm often looking for meal services to send to you guys when bad stuff happens in life. So yeah, really like Meredith and her approach. If you wanted any more information on that too, Kate Tuttle, one of our agents, uses Meredith all the time, so she can give you more information too. So Meredith, thanks for coming.
Thank you. I'll follow up and send you guys some information. So appreciate it.
Sounds great. Next up, we have our neighborhood speaker. Mr. Zach Canada is going to be speaking on Kennedy King. So Zach, just give me a minute and I will share my screen for your map.
Sounds good.
Never open up. Okay, there we go.
Nice.
Zach, take it away. Tell us about your neighborhood.
Right. Well, I hope everybody's been safe in the snow. I actually went to CrossFit this morning, only to find out that my accountability partner, who I won't publicly shame, Chris Glassberg, didn't show up, but I made it. So hope everybody else has been safe. Yeah, so I want to tell you guys a little bit about Kennedy King. I moved here in 2016. I live at 20th and Ruckle, which is 1 block east of Central. So the boundary there is Central to your west. 22nd is the north boundary. Then drop down to your south. Oh, hi, Natasha. Glad you're in the hood. To your south is 16th, and then run it east to the Monon. That's kind of our geographic square. So part of the reason I moved here is because of that. We're kind of nestled in a kind of a cool spot with, in my opinion, some of the best neighborhoods downtown. Here in Morton, which is actually the area I originally targeted, but found out that it's very expensive and was way over my budget. So settled for Kennedy King. A couple cool spots are, let's see here. We'll start with West Fork Whiskey. I don't know if any of you are familiar with that. Really cool spot. Currently Scarlet Lane, which used to be Cannonball. So really cool brew pub. They've got really good food too. So pop in there if you ever got a chance. The King Park development was over there. It's now Renew Indianapolis. They do a lot of great stuff for the neighborhood. And then RIP Country Kitchen, unfortunately, iconic spot. Caught on fire, I believe it's probably been almost 2 years ago now. They plan to rebuild, but they haven't yet. They're operating out of a different location, so fingers crossed they come back. And then that leads me to the King Park, which is a really cool space if you guys ever get a chance. It's huge. It's a huge green space. There's 14 acres, so just monstrous. There's a pool, it's a fairly new basketball court, playground, just great overall spot for kids, picnics, watch 4th of July fireworks, hopefully, once all the Corona stuff like settles down. And then within that park, there's a really, really cool memorial, which is called the Peace Memorial. So very brief history on that. April 4th, 1968, Dr. Martin Luther King was assassinated. So Robert Kennedy was actually in Indianapolis at the time and spoke to a crowd that were gathered to hear about the campaign. But instead of talking about the campaign, he actually spoke about the assassination. In some of the transcripts that I was reading, doing some research on this, he mentioned that Dr. Martin Luther King was dedicated his life to love and do justice for his fellow human beings, and he died because of that effort. So it's a really beautiful memorial. If you guys ever get a chance, please stop by. It's really neat, like I said. And then just enjoy the park itself. But that's my take on the neighborhood. So if you guys ever got any questions, feel free to hit me up.
That's so good. Thanks, Zach. Appreciate it. And yeah, if you guys haven't seen that memorial, it's so gorgeous. You should just go and check it out. Also, I love the shade that is being thrown in the chat. This is everything that I want out of this group. So thank you. Crystal, I'm going to turn it over to you for some announcements and recognition and all that good jazz.
Unmute myself. Hello, hello. So really quick, because I know we're here to hear Mark and I can't wait either. So 2 things we're going to be adding to our monthly agent meeting. So the first one, I'm going to give you time to be thinking about if you want to share, kind of explain that. But number 1, we're going to give opportunity if you have an upcoming listing, maybe a pocket listing or a broker's open that you just really want to briefly, and notice I said briefly. This is not a full-on commercial, but very briefly, if you want to share something about upcoming listing, something kind of like what we do on the Facebook group, you can also do that. You've got all these people. Now you can explain to your clients that you really are sharing those listings before they go on the market with a good group of agents. So you will have space to do that here in a minute and every month. And then the second and final thing, we're gonna recognize our amazing leaders from the previous month. And so if you forgot, I'll be sure to remind you here in a little bit. They are both on the call. That's exciting. One of them just got some shade thrown her way, so she's going to feel much better. But so I want to open up the floor to anybody that maybe wants to share a really quick upcoming listing they have, pocket listing, brokers open that's going to be coming up, something you feel like is really hot that you would like us to know, because we're all ears. Anyone?
Y'all just unmute yourself, or you can raise your hand. You can raise your digital hand and I'll call on you, whatever feels most comfortable. Zach Canada.
I have 2 listings that are going to go live hopefully the first week of March once all the snow melts. 7502 Donegal, south side, just off of 37. It's a 4-bedroom, 2-bath, 2-car garage. And then Mapleton Fall Creek, 3035 Ruckle, which is a 3-2 with a 2-car garage and a basement.
What are going to be? What's the prices on those 2, Zach?
7502 Donegal is going to be priced at $399, and 3035 Ruckle is going to be priced at $235.
Crystal, I've got one.
Go for it.
This fits nicely into Zach's presentation because it's about a block from West Fork Whiskey. A partner and I are building with Compendium Group. We're building a new construction spec house at 1661 Cornell. It sits on the Monon, the 1600 block of Cornell. Trade design studio designed, 2-story house, full finished basement, 2-car garage. Really great finishes. It will list at 650. Should be done in about a month.
Thank you. Anybody else? And I know some of you got put on the spot here. So you just know every month to be prepared. But before I switch.
I got one.
Yes, go Jacob.
I have a listing that should be coming up here in the first week of March. It was actually a halfway house in Irvington, 820 Lehman. It's a really beautiful property. It's got a lot of character. It's a 3-bedroom, 2-bath. Well, it's a 4-bedroom, 2-bath, but they built because it was a halfway house. They built out the basement a little bit, so it's going to take some creativity. But I'm really excited to. It'll be actually my first listing, so I'm super excited to get that one going. And wish me luck, guys.
Awesome! I love that. We all love new first listing.
One to that too. So I got something down in Greenwood. It's a 3, 2.5, fully remodeled, coming in at $199. Kind of a hot price point. So, but kitchen, bathrooms are all recently remodeled in the last couple months. Attached 2-car garage. So it's one of those like kind of vinyl village builds. But great price point still for the town. I got you, Angelica.
I love that. Anybody else?
I have one in Holy Cross. It's a 3 bedrooms, 2 baths, 14th block. Super cute. She's an interior designer. Goes live on the 4th of March. Have another one on Tacoma in Springdale. It's a 2-1, around 240.
2-4. What about for the one with the interior designer? How much is that one going for?
340.
340. Thanks.
And I have a wonderful listing, 1523 Southeastern, that I took off the market, coming back on the market. If anybody wants to go after that one again.
Awesome. Chris is the queen of Holy Cross. Anybody else before I transition? Awesome. Thanks, guys. Another thing, next month when we do meet up, keep in mind too, if you have a property that maybe has set on the market and it just maybe needs a little more explanation, like this might be that time where you can give a little bit of a quick pitch on that trouble property that you're maybe having a little bit of problems moving. So last but not least, for my segment, I just want to give a huge round of applause for our amazing listing leader last month, which was Rob Measle.
Yeah, Robert. Woo, woo, woo.
And then our fabulous sales leader last month, Kristen Glassburn. She might not show up for CrossFit, but she always shows up to pin those houses, right? And so just so you all know, because I've had a few people ask me, because they're kind of like, whoa, wait a minute, I want to get in on that action. And so how that is calculated every month is it's based on what you've done the first of the month to the very last day of that month, how many listings you had. And so not so much the total volume of those listings. If two people, let's say two people both had 3 listings, then we're going to go with the volume to break the tie, if that makes any sense. But it's just how many listings you have in that month. And then for the other one, the sales, it's how many you pinned. So how many you've actually sold. Now, we're not looking at the closed volume in that month. So everybody starts at 0 on the first of the month, and we figure it, and it ends at the end of the month. Hopefully that makes sense. Because you guys know that in order to have a great year, we have to have great what? Months. And to have great months, we have great weeks. Great weeks come from great days. And so I want you guys to all just be able to focus on having an amazing month. So we know that that year will be a kick-ass year for you. So Rosie, go ahead and take it away. I'm done.
Crystal, I'm like so in love with you. You're amazing.
Me and Rose do have a little bit of a relationship.
We do.
Outside of this.
Okay.
Wait a minute, Jenny's on this call. Wait a minute, Jenny's on the call. I don't want her to get jealous of our relationship.
Sorry, Jenny, we love you too.
Jenny, the rest of my love for you. Okay. I'm muting myself.
Okay, y'all, the grand finale, the thing you're all here for. Mark, Nottingham. All right, Mark, over to you. Have fun.
Afternoon, everybody. I'll go on record as saying I am pretty bummed that we weren't able to do in person. I think combination, we were going to have to limit the number of people anyway. And then with the way it's looking like the roads are going to be by later today, I think this was the right call. But the day is going to come where we get to be in person again to do these things. And I look forward to that. We might even just redo this same class just to do it in person. So I'm going to go right in and bust into a PowerPoint presentation here. Rosie, we're recording, right? So you're going to be able to go back and watch this if you'd like to. This is going to feel like rapid fire, but that's okay. You can go back and watch it. And any of the content here is stuff that you can redigest in a number of ways. So don't get too worried about that. I even have a little warning put into a part of the presentation about feeling like your head's swimming a little bit. So let's see. All right, y'all see that? Okay. So guys, this is like real estate 101. So investing in real estate is something that is incredibly common. It's one of the more common uses of capital around the world for the history of the world. And my thesis here is that realtors need to better understand investing in real estate. So within that thesis is the belief that realtors don't understand real estate as much as they can, or in my opinion, should. And it's kind of regularly been a surprise to me. So this isn't a chance to feel like, oh, like, gosh, I feel guilty about the fact that I don't understand this as much as I should. You can't change where you are right now, but you can affect your understanding into the future. And so that's the goal, is to think about, to whatever degree I understand investing in real estate right now, I should be increasing the amount that I understand, right? You don't have to get to expert level. just commit to the idea of whatever I understand now should be increasing over time. I'm going to reiterate the warning. If some of the things we talk about today are new to you, your mind is probably going to swim a little bit. You're going to struggle to follow. You're not going to know some of the basics, but that's okay. Stick with it. The encouragement here is don't let that stop you. When the concepts are new, they seem complex. It's a little bit of a cheesy illustration, but when you were 1 or 2 years old and you were learning to walk, it seemed really hard and it required every ounce of your mental focus to take one like little step at a time. Now, years later, you've practiced it a lot and you don't even think about it. It occurs to you naturally. And I can say this, guys, with 100% confidence. Every single one of you has the IQ necessary to grasp these concepts. They're not as complex as they seem. There's not a ton of them. When you understand the basics, you start to realize that they can be applied very broadly with a lot of commas between the numbers, but the concepts are the same. They don't get more complex as you go up. The concepts stay. And so learning the basics really does have a high return over time, but don't let the newness of them intimidate you. Okay. I thought about giving you a caricature, but I decided not to do that. I'll just kind of do it in hypothetical and say, I have encountered some people that get these concepts and have done very well in building wealth by investing in real estate, that in about every other sphere in life, you would look at and like basically think that person's not the sharpest tool in the shed. Okay. Like I honestly, if you're looking at the bar for like, what's the threshold of intelligence required to get these concepts, the bar is the people that are willing to commit to the time necessary to understand them. And most of the time when people get on the other side, they say, oh, those aren't very complex. Okay, so warning and encouragement over, hopefully that's made you a little bit more likely to buy into trying to understand. A little outline as to where I'm going to go today. First, we're going to talk about the why. Like, why does this matter? Why do I think realtors need to understand this better? I'm going to chat a little bit about other resources. There's nothing I'm going to talk about here today that is original to me. I can assure you there are thousands of places where you could get this same information from people who are more experts in it than I am. We're going to talk about the 5 ways to build wealth through owning real estate. And then we're going to talk about how debt leverages your money. Okay. So starting with the why. 4 reasons why. Number 1, it helps us better represent clients, even if you don't work with investors. So I think a realtor, even if you were to decide, I'm never going to own investment real estate, I think that'd be a mistake. But even if you were to decide that, there's a really compelling reason that you need to better understand investment real estate. And it doesn't even matter if you work with investors. There are going to be properties next door to the one your buyer is buying, or there are going to be properties where you think the buyer is a homeowner, but the buyer might turn out to be an investor. And so you're going to want to understand the language that they're using. So I would actually say, even if you don't work with investors, you can't really escape, nor should you try to escape working in the investment side of our business. Okay. Number 2, you as a realtor are likely to have significant disposable income at some point in your career, particularly later in your career. Realtors' income is unpredictable. And so realtors don't tend to build their expenses off of how much they're actually going to make, because you shouldn't. So I'll use this as an example. An experienced realtor actually right now is making about the same as an experienced physician. Well, an experienced physician knew a decade in advance what they were going to make, and they might actually build their expense structure in life off of that income. Realtors don't tend to do that. And so later in their career, this is a great problem to have. You end up with a lot of disposable income later on in life and not sure what to do with it. Number 3, this is a big statement, but if any of you would like to debate me on this, I'm happy to do that. Y'all know how much I enjoy debating, or some of you probably know that. Jenny is probably rolling her eyes at the moment. Over the course of history, all over the world, owning real estate has been the most common and predictable means to build wealth. And it's not even close. So, guys, there are certainly unique amounts of attention and coverage that get paid to the Apples and Googles of the world, right? There are other ways that people amass a lot of wealth. That's the 1%. If you look at a list of the wealthiest people in the world, the vast majority of them have built and maintained their wealth through owning real estate. And that's true for as long as the world's existed. Even the companies, I was talking about this with someone yesterday. If any of you have happened to watch the documentary about Ray Kroc, the founder of McDonald's, Walmart, these businesses that have amassed billions in value that appear to be retail businesses, they're actually real estate companies. That's what they are. You look at the profit loss, the balance sheets, how is it that they're actually making money? They're real estate companies. In addition to all of the investment real estate that is out there. So this is the most precedented means to building wealth. Number 4 is that you're an expert. You have great access to information. You have a competitive advantage in acquiring real estate, whether you're using it or not, or whether you're trying to grow that competitive advantage is a different question. But you do have expertise and information that other people don't. And so to me, all the more reason to understand these basics of investing in real estate, because the hurdles between you and investing in real estate are lower than they are for the general public. Okay. So now that I've maybe convinced you as to why you should care about this, I want to reiterate that there's no originality to anything I'm going to say here. I recommended prior to this that you read The Millionaire Real Estate Investor by Gary Keller. I'm not going to try to rehash what Keller has said in that, but I think it's a great way, particularly if you hear some of these things and your head swimming a little bit, maybe a written out version of some of these is a good way to redigest. I think also the more that you engage with these written resources, the more you're going to draw certain things from the way that people present them. So I think it's really interesting. I suggested last year to an individual it's not a realtor, just somebody I know here in town. I made 3 book suggestions to them. And what was interesting is that he said while he was reading those 3, it seemed like they were all talking about different things. But by the time he was finished reading all 3 of them, he realized they were really all talking about the same basic principles. He was just hearing them from different communicators. Millionaire Real Estate Investor, Rich Dad, Poor Dad by Robert Kiyosaki. A lot of you have read that. And in case you're wondering, I did drop in The Art of the Deal as a total joke. I actually don't recommend The Art of the Deal for anyone. If y'all know who wrote that. Number 4, though, I really do. Building Wealth One House at a Time. That's a book that really simplifies how this can be done. And there are literally hundreds of other resources, podcasts, audiobooks, written books video presentations. Like, it's not hard to find resources about how to build wealth in real estate. And my encouragement is to take advantage of as many of those as you can. Okay, so I'm going to go over 5 ways that you can make money / build wealth in real estate. And I before I give you the 5, I want to say these are not mutually exclusive. So you don't pick one of these as your means to make money. And a matter of fact, a lot of really good real estate strategies are capitalizing on 3, 4, or even all 5 of these. I think what's important to understand about there being 5 categories is I see people that are newer into real estate investment get really focused in on one of the 5, which is fine. You can develop a good strategy in one of the 5, but you can also handcuff yourself if you're really focusing on one of them. One example of this, we'll come back to it, but flipping a house, right? Flipping a house feels like the most common, accessible. HGTV has probably not done a whole lot of favors for people in terms of making that like the catch-all, but it's like a subcategory of one of these 5. Okay. So the 5 ways to build wealth in real estate: acquisition, conversion, cash flow, tax strategy, and appreciation. I'm going to go back through each one of these, and we're going to give some examples of each one. But if you don't catch anything else today, I think it would be really good to catch that any one aspect of owning real estate, if you're zoomed in to any one aspect and the profit and the wealth building opportunity there, you're probably not grasping how compelling investing in real estate really is. So it doesn't mean you necessarily have to understand all 5. You can grow into that. But by looking at all 5, my hope is you begin to understand, wow, this is a really compelling thing when you start to add up these 5. Okay. By the way, I am going to stop a couple times. I'm going to stop after each one of these to take questions. But you can also jot down questions and ask them at the end. Okay. So because I might answer a question while you're thinking of it. So number 1, acquisition. Buying a property for less than it is worth today. Okay. And these are in order, in theory, they're in order of like a timeline of like when you buy real estate, where in the points in that timeline can you make money or build wealth? They're not really in any great specific order though. So buying a property for less than it is worth today. Some examples of this. We haven't seen a foreclosure market in years, but when I got into real estate, this is actually why I got into real estate. I was tired of looking at foreclosures. There was a lot of properties listed that were owned by banks who were willing to sell them at less than they were worth, but the market was pretty skittish about buying them. And so they really started to climb in inventory. Tax sales, sheriff sales, county surplus auctions, properties tend to trade hands in these places for less than they're worth at the moment of sale. Okay, so I'm going to emphasize that. I'm not talking about buying a property today for less than you could sell it for in 5 years. That's a different one of these categories. I'm talking about buying a property today for less than it is worth today. The entire wholesale industry in real estate. For as much as I don't care for a lot of the things that take place in the wholesale industry, I'm not advocating for all of those right now. It's built on this concept. That's what the wholesale industry is built on. Literally, there's people that will find a property owner that will commit to selling them a property for $50,000 that's worth $80,000. The wholesaler then has 30 or 60 days to go and sell that property for $70,000 or $80,000. That is a profitable strategy. There's other issues in the wholesale industry, but there are means, in my opinion, some legitimate, some illegitimate, to buy a property for less than it is worth today. Okay, so this is acquisition. You make money in this category when you buy the property. Questions on acquisition? Feel free to unmute yourself, or you can drop it into the chat, and I'm figuring out. There we go. Any questions on acquisition or comments? Okay, I'm going to keep going. We might come back to acquisition. Number 2 is conversion. So the concept of conversion means that you're investing resources to change the nature and value of real estate by more than your investment. Okay, so you own a piece of real estate and you're going to do something to it. You're going to invest time, energy, expertise, money, marketing, something. You're going to add a resource to real estate that you already own. And by doing that, you increase the value of the real estate by more value than whatever it is that you invested into it. Okay, so I'm going to give you some examples of this. Taking a vacant piece of land and building a new house on it. I just mentioned that I'm with a partner currently building a spec house. Right? You're taking a piece of dirt and you pay money for materials and labor to convert the piece of dirt to a piece of dirt with a house on it. And that the building of wealth, the making of money there is that whatever it cost you in materials and labor to convert the piece of dirt to a house, that you increase the value of the real estate by more than that resource investment. A house renovation is the most obvious and common of a conversion method, right? That you buy a house for $100,000, you put $100,000 in renovations into the house, and it's worth more than $200,000. You made money by converting that piece of real estate. There's lots of other ways, though, than building on a piece of vacant land or renovating a house to make money through conversion. I'm going to give you a couple more examples. A property tax appeal. Buy an expensive piece of real estate that's assessed at $2 million, but you know that you're going to be able to lower the property tax. So you can appeal the property taxes. You've invested your expertise and time in the house, and by lowering the assessed value, you lower the property taxes on the property and you just increase the value. Okay, that might make your head swim a little bit, but my point there is that not all conversion has to do with spending money on the property. You buy a strip mall. I'm sure all of you are just real excited about the possibility of owning a strip mall someday. You buy a strip mall that has 5 storefronts and one of the 5 is full. But you buy the strip mall, you invest the time and energy, and you get 4 more tenants in there, and you have converted a strip mall into a cash flow producing asset. That cash flow is number 3 here, by the way. So it's not just about making the money on those leases. That what you did, you took a 5-unit strip mall with 1 tenant and turned it into a 5-unit strip mall with 5 tenants. You just radically increased the value of that real estate. Okay. Maybe combining adjoining parcels. So you managed to buy 3 or 4 different properties that had 3 or 4 different owners that adjoin to one another, especially if they're vacant land. You don't have to do anything else. That your conversion there was that you took 4 small pieces of property and turned them into 1 large piece of property. You've increased the number of people who would be interested in that property, therefore increasing the value. A change in zoning. If you buy a piece of property, C5 is a particular type of commercial zoning that there's not a whole lot of in Indianapolis. C5 is what allows for a car dealership. So, you know, there's actually not many geographies in the city that a car dealership can exist. If there was a piece of real estate that you were confident you could get the zoning changed to C5, if that was your area of expertise, you could buy that property, do nothing but get the zoning changed, and you converted it, pretty significantly increasing the value. Marketing a possible project. Raise your hand if you're familiar with what happened at the Waterside development, the GM stamping plant. Ambrose, a local developer, bought that property from this Racer Holding Trust. So it used to be owned by General Motors. They had a factory there. Well, General Motors took the property into a trust because of the environmental issues on the property. And Ambrose, a local developer, bought that property from Racer Trust several years ago. They got some zoning approval. They got some tax increment financing put into place, and they marketed that property. I mean, they had it in the IBJ about every other week. It was in the Star all the time. They, I mean, the development itself, not just Ambrose, but the development itself was a Pacers sponsor and a Colts sponsor. I mean, they had this name all over the place. It was the spot where Amazon was looking for their second headquarters, and people thought maybe Indianapolis had a chance at that. I don't think we did, but that was the spot where it got talked about. Sheerly by marketing the possibilities of that property over the course of several years, Ambrose radically changed the value of that real estate and never converted it. They never did an actual physical thing to the real estate and I'd have to go back and look, but well into 8 figures. So like well over $10 million. I think it may have been 20 or 30 in terms of what they bought it for and what they sold it for. Not suggesting that's always repeatable, but my point there is that there are a number of things that you can do to a piece of real estate to change its value in excess of what you invested. Okay, so that's conversion. Hitting pause before I go to number 3. Questions on conversion?
I had a question on that. You kind of mainly gave examples of commercial options to related to tax reassessment. When it comes to residential investment properties, like I know, like practically, you can often pick up properties that are way under assessed, that are investment properties, and they catch up pretty quick on you. But then with that, there can be an overcorrection. Is that primarily what you're speaking to? Like if in the event there's an overcorrection, like getting that reassessed, or I'm kind of curious on the very practical, like what it actually what's the process to get that done? And
so a typical single family in Indianapolis right now is more likely to be under assessed than it is to be over assessed, right? So Joel is making the point here that lowering the assessed value of a piece of real estate requires that you think it's over assessed right now. So Joel, really just an example of what could be done to create value through conversion. It's not very likely to be able to be done on most single family houses in Indianapolis right now. You're actually correct. It's more likely that the opposite is going to happen if you buy a single family investment property. The assessor is going to catch up. Joel, an example of this, that something that might be over assessed would be a multi-unit or a commercial building in a part of town that is like kind of struggled for a couple decades, something that, you know, was built out decades ago and maybe has kind of destabilized, think Lafayette Square. There'd probably be some commercial buildings in Lafayette Square where you'd look at the assessed value and think, oh my gosh, this property is worth a fourth of that. Well, if you buy the property and manage to appeal the assessed value based on your purchase price and get the assessed value lowered, you did just increase the value of the property. I know that's counterintuitive. You're like, wait a minute, you get the county to lower the assessed value of the property and that increases the value. It does. The buyer wants the taxes lower. Anybody's head spinning yet? It's okay. Other questions on conversion? Okay, I'm going to keep going. If you want to jot down questions, that's great.
Mark, before you go, I was just gonna make more of a comment. That's just an added incentive to investing and buying single family or under 4-unit places, because you're often getting low tax assessments on the front end. Just, you know, kind of goes into ability to cash flow and things like that.
That's right. Yeah, these strategies obviously complement each other, because if your assessment's high, you have the ability to gain value by converting the property into a lower assessed property. If the assessment's low, it's easier to cash flow. Okay, number 3, cash flow. Renting a property for more than it costs you to own and maintain it. This is the most common. Of these 5, this is the most well-known. This is the one that is like the truest, easiest way to repeat making money and building wealth in real estate, is that you can buy an asset that generates more income on an annual basis than it costs you to own. So when people talk about capitalization or cap rate, okay, this is what they're getting at. Cap rate is your income minus your expenses divided by the value of the property. Cap rate is income minus expenses divided the value. I'm going to give you an example of this so you can kind of see it laid out. We're going to use this example of a $100,000 house quite a few times. So just picture the house. It's $100,000 and you can rent this house for $1,000 a month. Okay. So it projects to $12,000 in annual income. Now, what I'm going to suggest you use as your formula to project out cap rate says that 10% of the time the house is going to be vacant. So if you can rent it for $1,000 a month, in theory, you could get 12 grand a year in income, but it's not always going to be full. So you use a 10% vacancy factor. Residential market averages in Indianapolis right now, you could actually use a 5 or 6% vacancy factor. So I'm being conservative here in all of my numbers. 10% management. You might self-manage the property. If you own 1 or 2 rentals, you probably are going to self-manage the property. But the day may come where you would hire someone to field the maintenance calls and to gather rent checks. And you're going to pay them 10% of the income to do that. Okay. If the property is worth $100,000 and it's a residential investment property, eventually you will probably be paying $2,000 in taxes per year. Marion County, you pay 2% on residential investment real estate. You're probably going to be paying less than that on taxes on the front end. The house that you could buy for $100,000 right now might be assessed at $60,000, which means you're actually only going to pay $1,200, but eventually you're going to pay $2 grand. It might cost you $1,000 a year to insure the house, and you might project $2,000 of annual maintenance. Okay, don't worry too much about my assumptions. I'm being conservative here. This is just to help you understand what cash flow is and how you calculate cap rate. Cap rate does not bring into account debt. Cap rate assumes that you just flat out buy the house in cash. Okay, I'm going to come back to the why of that and what debt and leverage does, but this is about cash flowing a piece of real estate, whether you have debt on it or not. Okay, so in this particular case, this $100,000 house projects to net you $4,720 a year. Okay, you're bringing in $12,000, but after you cover all the projected expenses, you're earning $4,720 a year, which means this particular house would have a 4.72% cap rate. Okay, because it was a $100,000 asset that produces $4,720 of income a year. So 4.7% of your investment comes back to you year after year from cash flow. Okay. Questions on cash flow? Questions on my assumptions?
Sorry, maybe I missed this. Does CAP stand for something, or what does that actually mean?
CAP is short for capitalization rate.
Gotcha.
So essentially, at what rate is your capital returning to you on an annual basis?
Okay.
So if
Yeah.
$100,000,
And is there a certain, yeah,
go ahead, Michelle.
is there a certain, I would say, is there a certain cap rate that investors are usually looking to stay between or for it to be a good deal in order to make a deal?
Yeah, it varies based upon a number of things. What part of the country are you in? Interest rates affect cap rate expectations. The supply and demand in the market affects them. What type of real estate you're buying. All of those are impacted. All of those impact what an investor expects to receive. Under most conditions, a cap rate, for example, of 4.7% isn't very good. Like this would be a very conservative investment. $100,000 house, you could probably rent for a little bit more than $1,000. It's not going to be vacant for 10% of the year. Your taxes probably aren't going to be $2,000. I bet you could insure it for a little bit less than $1,000 and maintain it for less than $2,000. In reality, $100,000 house right now, going cap rate's probably going to be in the neighborhood of 6 or 7% in Indianapolis. So the better the market, the lower properties trade at cap rates. So like when I got into real estate 12 years ago, you could produce a cap rate of 10% like pretty easily because there wasn't a whole lot of buying going on. Right now, 10% is like really hard to replicate. 6, 7, 8% is about kind of the going cap rate.
Okay. Cool. Thanks.
Okay. We'll move on past cash flow. Tax strategy.
Hey, Mark, will you check the chat?
Yes, it will.
A couple questions.
Okay.
I can just ask the question. Yeah, I'm just wondering at what point do you calculate like anything that you would, any value you would add to the property, like rent increases to what you're gonna get your assumed value at in terms of investing in the property?
Yeah, rent increases really fit nicely into number 5, which is appreciation. That as a property's either sale or rental value goes up over time, that is what I'm calling appreciation. So I would calculate future increases to sale or rental value in that 5th category.
Nice.
Jake asks, is this cash on cash calculation then, assuming that you don't use debt? Yes, this is cash on cash calculation. You have $100,000 in and you're getting $4,720 in cash coming to you per year. So if you kind of ignored everything else, this is cash on cash. No one that invests a lot in real estate owns $100,000 houses with no debt. And we'll take a look at why. So cash on cash generally involves a lot of other factors too. Yeah, Sue kind of brings up the comparison to the market. I think this is actually one of the things. I have a friend who is a financial advisor that does a lot of trading in the market, and he always kind of teases me and I tease him. He's not really invested much in real estate, and I'm not invested much in the stock market. And he is skeptical that real estate really beats out the stock market because I think people get zoomed in. So just FYI, historically, the stock market tends to increase at about 8 or 9% a year. If you were zoomed in only on cash flow, so you said, what's going cap rate versus how does the stock market do? They tend to be pretty close to each other. Okay. Where this really starts to take off, though, is in your ability to leverage real estate using debt, which you can't do in the stock market. And at Sue's point, we're going to get to tax advantages and appreciation to the real estate. So if you get zoomed into one of these categories, it looks like the stock market outperforms real estate. When you look at them as 5 categories, I would make the argument that the stock market never outperforms, not as a whole. Individual stocks certainly can, but the stock market as a whole doesn't. Silva has asked, so cap rate would go down if the value of the house went up, but the rent didn't. Yes, that's exactly right, Silva. This is why people tend to sell rental properties at some point in time. So you buy a single family house, the cap rate looks pretty good, but the rent of the house doesn't go up over time, but you know that the value of the house selling it goes up over time. Eventually your cap rate's going to be low enough that you would say, oh, I should just sell this. So both that and the opposite. The rent might outpace the sale value, or the sale value could outpace the rent value. Oops, good questions. Silva, I don't know, but always happy to take a look at it with you if you would like. Okay, going to number 4, tax strategy. Tax strategy and using debt for leverage are the 2 areas where this can really get confusing. Stick with me. Understand everything that you can. If nothing else, know that it is fairly obvious that the people who have written our tax laws for hundreds of years own a bunch of real estate. When you start to understand the way in which our tax laws are written, and we talked about this in the Finance 101. I'm not advocating that this is the way this should be. I actually think this is problematic for the overall health of our country's economy. But it is the way that it is, and I think it's at least on us to understand it, because there are enormous advantages in terms of tax strategy to owning a lot of real estate. I'm going to explain 2 of the most significant ones. And guys, this is, we talked about this in the Business Finance 101. This is why President Trump fought so hard about his tax returns being released. A multi-billionaire, year after year after year after year, was essentially paying $0 in taxes. And I can promise you, He's not the only one. If you own enough real estate, it's doable. And I'm not suggesting it's preferable that the structure is that way, but realtors are a really good example of a profession that has the capacity to make good money and doesn't often think through a like clear tax strategy to make sure you're being wise and like mitigating your tax burden. And which I think is crazy because real estate's the best tax mitigation strategy there is, and we're experts in real estate. Okay, so I'm going to talk about two of the tax strategies, and these are the most important of what I mean by tax strategy. The first is depreciation. So if you've ever heard this term, straight line depreciation. So the building portion of residential rentals can be depreciated over a schedule of 27.5 years. This is according to the IRS. So this is tax law. So what that means is if you're $100,000 rental house, you make the case that the dirt is worth $10,000. The house itself, the improvements are worth $90,000. So it's 90% improvements. You can claim roughly $3,000 a year in quote unquote loss. So you remember back that your $100,000 house is earning you $4,750 of net income per year, making you $4,700 a year. You can declare a loss of $3,000 per year for 27.5 years. What that means is you'd only be paying taxes on $1,750 of your profit. That's straight line depreciation. You're declaring a loss per year on the value of the house. So somebody answer a question that might seem obvious, but I want somebody to unmute themselves. Do most houses depreciate in value every year?
No.
Thank you. I think that was Natanya. No, as a matter of fact, almost no houses depreciate on an annual basis. So we're going to get to number 5, which is appreciation. Catch this. The IRS lets you pretend that an asset that is actually increasing in value every year is depreciating in value, therefore lowering your tax burden. It's legal. I'm not saying it's right, but it's legal and you got to understand it. So your $4,750 of actual cash profit, you only have to pay taxes on $1,750 that in this example. You start to build an inventory of real estate and this starts to become a really big deal. Okay. Sorry. The two of these are connected to each other. So straight line depreciation allows you to declare a loss on the value of a house every year. Okay. So what that does is that, let's say you own that house for 10 years. Now, according to you and the IRS, your relationship with the IRS says that 10 years later, the improvements of that house have gone down by $30,000 in value. So your thing that was worth $100,000 is now worth $70,000 10 years later. Okay. That's the relationship between you and the IRS. You've said it's worth 70. They've let you declare that, which is good news because you've just lowered your tax burden every year. Here's where a 1031 exchange really becomes the kicker to this. If you ever just are hungry for some more continuing education and you have the opportunity to take a course on 1031 exchanges, I'd encourage you to do that. I did this like a decade ago. I've done several 1031 exchanges myself. I've helped clients do 1031 exchanges. This is where the tax code becomes incredibly beneficial to people that own real estate. So walk with me here through your $100,000 house. As you depreciate that asset over time, you're pushing taxes into the future. Okay. And what you're doing there, the $100,000 house, walk with me through here where I have this example. After 10 years of owning your $100,000 rental, you have depreciated it to 70. So you saved taxes over the course of a decade. But it's actually increased in value to $200,000. Not uncommon for a $100,000 house to double in value over the course of 10 years. That would actually be fairly typical. Well, 10 years later, if you sell that house for $200,000, you would owe what are called capital gains taxes on the $130,000 of gain. Okay, so you've said to the IRS, this house is worth 70 on my balance sheet or my personal financial statement. It's worth 70, but I just sold it for 200, which means I'm declaring $130,000 of profit that you have to pay capital gains taxes on. Capital gains tax rate right now is about 20%. So you'd actually have to pay $26,000 of that in taxes, unless you do a 1031 exchange. You could take that $130,000. If you didn't need to use the cash for something else, you put it into an exchange and you use it as a down payment to buy a $500,000 fourplex. You took a $100,000 asset that you own for 10 years, got all the tax advantages of owning it for 10 years, got the cash flow advantages of owning it for 10 years. You took advantage of the appreciation over 10 years. You made all that money, the vast majority of which you don't have to pay taxes on if you transfer that gain into a larger piece of real estate that now has more potential for cash flow, tax advantages, and appreciation. This is the compounding effect of real estate and the fact that you can indefinitely push the tax burden into the future, as long as you stay vested in real estate. If you can indefinitely push the tax burden off into the future, capital gains taxes basically then don't exist for you. This is how a billionaire doesn't pay income taxes in the United States.
Mark, what happens when you die? Like, say you keep on sorry, too dark. I'm just gonna leave my question there. You know.
Your estate. So whatever your estate is would inherit all of these things. And there are estate taxes, but that's true of wherever your wealth is. So if you own stocks, if you own real estate, if you own cash, if you own equity in companies, whatever wealth you've accumulated in your lifetime, if you die and that wealth is inherited by someone, that person does have to pay an inheritance tax on that wealth transfer, but it isn't unique to the real estate. That's just a function of what estate inheritance taxes are. Spoiler alert that tax laws are also written by people that are trying to figure out how to pass along generational wealth without too much of a burden. So there are, like, if you are planning out your estate over the course of decades, there are a lot of ways to minimize that, and real estate's a pretty darn good one. So yes, there is an eventual tax burden, but your inheritance only face the heavy part of that burden if they go to sell the real estate and don't convert that money into more real estate.
And Mark, 1031 exchange, that only applies for investment real estate. So for instance, like I live in my house that appreciates $100,000 and I use that to buy my next house, I can't use a 1031 exchange in that instance, correct?
That is correct, though in that instance, you don't need to, because there is an exemption on capital gains taxes for your primary residence.
Got it. Okay, cool.
So for all of you realtors on the call, when you're at the closing and the closer says, was this your primary residence for at least 2 of the last 5 years? That's why they're asking that question. Because in Indiana, there's a capital gains exemption, there is any state, the amount that you're exempt changes based upon where you live and whether you're single or married. But generally speaking, in Indiana, the sale of primary residences don't incur capital gains taxes because they fit under the exemption, the exempt amount.
Mark?
Yes, sir.
I recently learned, I didn't know this on capital gains, but you can also get partial capital gains benefits of like, if you've occupied for 1.5 years. I did not know that prior, but my CPA just educated me.
Yeah, and the sale of real estate can be burdensome, but gosh, there's a lot of ways to utilize this. A relationship with a good CPA is a good way to do this. CPAs, they're one of the ways in which you can do a 1031 exchange. So we could do a whole class sometime on 1031 exchanges, but I wouldn't be the person to teach it. I could have someone do it, but there's actually, you can get continuing ed for taking a class on 1031s. You typically use some form of an intermediary, and CPAs are one example of that, so that you don't actually ever get the money. You sell the house for 200, the 130 sits in an account that you don't have control over, that you have so many months to take that money and buy another piece of real estate, and then you're exempt from the capital gains taxes. I know tax strategy. I mean, my goodness, is there something more boring than talking about tax strategy? Maybe not.
Can I ask, can be split between 2 properties? So if
yes.
I can, yay. Okay, thank you.
Yep. 1031s. It's called a like kind exchange. So there are rules that do occasionally change on what the IRS means by like kind, but the number of properties doesn't necessarily limit you. So you could sell 1 and use those funds to buy 2 or more. What generally happens in a 1031 is people are upping the value. They're liquidating equity on one piece of property and taking the gain and using it as down payment, like I have in my illustration here. Otherwise, like, why sell the $200,000 house? You would have never incurred the tax burden. You can incur the tax burden, but then avoid it and then increase the return on your money by owning more expensive real estate. Thrilling, I know. Any other questions on tax strategy, on depreciation or 1031 exchanges? Okay, do y'all see how they work together? You own a piece of real estate for 30 years. Depreciation allows you to just push taxes every year. And at the end of 30 years, if you sold that, you'd have a massive tax burden. The 1031 saves you from the massive tax burden. So those two work.
This is maybe a dumb question, but like, accountants are generally aware of this principle, right? Or like, do I need to like be like, yo, accountant, make sure I'm getting that depreciation?
That is not a dumb question. Yes, I would say good CPAs are certainly aware of the ability to depreciate real estate. And I think a 1031 exchange is not as likely to come up in conversation because you may not be talking to the CPA at the point of selling that. piece of real estate, but if you bring it up with them, they should. I mean, hey, I'd also like, look, could a CPA roll their eyes at you if you bring up depreciation, like you're trying to teach your CPA something? Sure. But don't be afraid to look stupid. Like, make sure you're taking advantage of all the tax strategies you can in owning real estate. Okay, I'm going to number 5. The 5th way to build wealth in real estate is appreciation, increase in value over time. So this is an increase. Generally speaking, appreciation is thought about in terms of the increase in what you could sell that property for. If the rental rate is increasing, generally the sale rate is increasing too. They may not increase at the same rate, but we're generally talking about what could you sell that property for, okay? So historically in the United States, real estate on average appreciates 3 to 4% a year. Like stock, predictable over the course of time, about 3.5%. Certain areas beat that through, say, neighboring development or population growth. So y'all know we've been talking about this as a company and as an industry. October, November, December, January, the last 4 months in our marketplace, year over year price increases between 15 and 20%. So January of 21 versus January of 20, prices went up by 18%. That's, honestly, it's insanity, but that's appreciation. And it's essentially 4 times historic average appreciation. Okay. Now, can you go out and replicate 18% appreciation? No, not very often. But when people buy real estate like speculatively, you say, boy, the population in Hamilton County is really growing. If you could go back 30 years ago, like, look, well, Hamilton County, I bet this place is going to explode. I should probably buy that cornfield that's sitting at 150th. Because the population is growing and there's all this development happening down there south of 130th. Well, you would have made a good decision if you had done that, because you didn't convert it. You just bought it and sat on it and watched. And it would have appreciated way more than 3.5% a year. It probably would have increased by a factor of 10 over the course of 20 years. So appreciation, we don't want to take it for granted, but this does happen. It's predictable. And yeah, I think if you're looking at how does appreciation historically compare to the stock market? Again, if you get stuck in looking at one of these two things, you would say, well, a stock tends to increase in value on average more than a house. That is true. A stock increases historically at about twice the rate that a house does in value. Well, a stock only makes you money in one way. Y'all follow that? This is the only way in which the stock market creates wealth. In real estate, you also have the tax advantages, the cash flow, the ability to convert, okay? And the ability to buy a piece of real estate for less than what it's worth in the moment. Stocks don't tend to let you do that because the market information is more out there. I can explain what I mean by that. But my point here is that when you look comprehensively at the 5 ways to make money in real estate and begin to try to understand all 5 of them together, this is why real estate is the most precedented and predictable means of building wealth that the world has ever known. One last note about appreciation. It's a curb against inflation. So generally speaking, real estate appreciates at a slightly higher tick than money inflates, which means sometimes people just go out and buy land knowing that it will probably appreciate at 4% on average, which is better than having that money sitting in the bank. You'll see that the money becomes less valuable if you own it in cash. Not to get real deep into this, digital currency, Bitcoin, is like a currency that curbs against inflation because they're not making more of it. Bitcoin's almost like a real estate version of money. If you really want to nerd out on this sometime, we can get lunch, or probably better to be over some sort of alcohol. I'll explain to you what I mean by that. But putting money into real estate increases in value over time, where actually having money sitting in cash decreases in value over time. I know there's a ton there. I'm going to hit pause for a moment. 5 ways to build wealth in real estate: acquisition, conversion, cash flow, tax strategy, and appreciation. See how they're kind of in order of the timeline? You can make money the day that you buy the real estate if you get a really good buy. You can make money by converting the real estate through investing some sort of time, expertise, or money. You can make money by renting the real estate to someone else and generating positive cash flow. You can make money through tax strategy by depreciating real estate over time and exchanging it using a 1031. And you can make money by owning real estate over a long period of time, where it increases in value through no effort of your own, just from market forces. When you add those up, it's a really compelling model. Haven't gotten to debt yet. I'm going to hit pause and give your brain 1 minute to rest. But I would love to field questions on just the mix here, the combination of these 5 things. Give me feedback on how your brain's doing at the moment. I'm also opening the chat, so feel free to drop it into the chat or unmute yourself. Okay. I'm just going to trust that you're with me then. Love it. These are the 5, if you will, they're the 5 buckets. They're the 5 categories in which someone who owns real estate can build wealth. And again, you don't do this in one of these categories typically. It's some combination of these 5. And to this point in the conversation, I haven't talked about borrowing money. Okay, so borrowing money is something that allows you to multiply any of these 5. Okay, so we typically talk about debt as leverage. So leverage is like the positive word to use about debt. So I'm going to talk about debt for a minute. And debt isn't really a 6th category. Debt is its own category that helps you multiply the wealth that can be built in any of these 5. Okay. So leverage. Why is debt such a powerful tool? Sorry for the cheesy picture, but it might help you understand what the concept of leverage is. If you all remember back to your high school physics class, leverage is it's a scientific principle that talks about being able to do more than you could without it. So the visual here, the physics behind this picture is that individual in that picture isn't strong enough to lift the big rock if they just use their hands. But without any other human beings or any other energy involved, the little rock and the pole that he's using there, he or she, that's leverage. That person can move that rock. The leverage helps them to do more than they could do otherwise. So in that illustration, the little rock is a mortgage. It's the cutest little mortgage I've ever seen. I'm gonna walk through an example here. So we're gonna revisit your $100,000 house. So sometimes I'll have friends or clients say like, well, I've got the cash to go buy an investment property. I don't want to use debt. Y'all heard me in the Business 101 class. Maybe be a bit critical of Dave Ramsey. Dave Ramsey, very popular. I think he's been a good influence on a lot of people. But he's very anti-debt. And I think he takes an intentionally simplistic view of debt. So I'll sometimes have people say like, well, why should I use debt if I don't have to? Well, if you have to use debt, then you're probably not in a very secure position. I'd say generally speaking, the most mature real estate investor isn't using debt because they have to. They're using debt because they understand the concept of leverage. I'm going to walk through two scenarios here. So I'll use Rosie as my example. Rosie, congratulations. You have $100,000 in cash sitting in your pocket.
What's that?
Way to go. There's two different scenarios here that Rosie can choose to use that $100,000 in two different ways. The first is going to be on the left, and it's the cash purchase. The second's going to be on the right, and it's leverage purchase. Okay. So the cash purchase, she goes out and buys one house with no debt. She has $100,000 invested per house because she only has one. Okay. That house, if you go back to our example, produced an annual NOI, net operating income, of $4,750. So her cap rate and her ROI, which is return on investment, is 4.75%. She has $100,000. She went and bought an asset with that money. Didn't borrow anything, doesn't have any debt costs. That $100,000 is making her $4,750. And when you add in projected appreciation and tax savings, her ROI goes to 10%. So she took her $100,000 and year by year, she is increasing her net worth by $10,000 a year. Not a bad investment. Very conservative, very safe. She took the $100,000, put it into an asset, and that's going to increase her net worth by 10 grand a year. Boom, boom, boom. Okay. Not a bad idea, but not leveraged. The second option of what she could do with the $100,000, she's going to go buy 4 houses. But to buy 4 houses with $100,000 that are worth $100,000 a piece, she has to borrow money. So she's going to buy 4 houses all with debt. So she's going to get a 75% loan to value mortgage for each of them at 3.5% interest. All the assumptions vary here based on market conditions, but just walk with me through the example. Okay. So with the same $100,000, she now owns 4 houses. She has $25,000 invested per house. That's her down payment. Each house now produces net operating income of $2,025. It's lower than the $4,750 because she has to pay interest. She's added an expense. She didn't actually lower her return though, because while the cap is still 4.75, the houses themselves without debt are still returning that 4.75%. Her ROI is 8.1 because, try to follow me here, she has $25,000 invested in each house. So now 25 is producing just over 2,000 a year. That's a better ratio than $100,000 producing 4,750. So she improved her ROI by using the leverage. Here's where this starts to get really compelling. When you add in appreciation and tax gains, you now have 4 assets that are appreciating in value, and you have 4 assets that allow you the depreciation and 1031 games. Your ROI goes to 28.1%. So let's say these houses are appreciating 4% a year. Now you have $16,000 of appreciation every year, just because your leverage allowed you to buy 4 that are appreciating. You also have the added tax gains of depreciation. So your $100,000 leveraged is increasing your net worth by $28,100. So I understand Dave Ramsey's aversion to debt, because in Western capitalist society, most of what we mean by debt is consumer debt. It's credit card debt. It's not to buy an asset. Using debt as smart leverage to buy more assets than you could have otherwise, so long as you have the ability to tolerate the added risk that the debt is a way to roughly triple your outcome. Now, these numbers may not always be the same, but debt generally does triple your outcome. That number remains consistent. So you see the price of the house, the going cap rate, how much money can you borrow, what's the interest on that money, all those numbers kind of float up and down. One thing does hold true, is that debt typically is going to be able to roughly triple your outcome. If you're not sold on debt yet, then I would encourage you to continually revisit this in your own exploration of investing in real estate. I think this can be dangerous. So I don't do this by yourself. As you're considering purchases, as you're considering debt, find good advice. I may or may not be good advice. And guys, you have anytime you want to get me to take a look at a potential investment that you're looking at, I'm happy to do that. Find other people, find other resources. Leverage is a very powerful tool. Can people get over leveraged? Yes. This is what happened in 2008. You had a lot of people that weren't 75% loan to value. You had a lot of people that were 110 or 120% loan to value. That's a bad idea. Don't borrow more money than the asset's worth. Just a general rule of thumb. Banks, under certain market conditions, will actually let you do that. Question on the concept of leverage or my 2 scenarios? Rosie, congratulations, by the way.
Thank you. I'm very proud of myself.
No questions on leverage? It's because I got too deep into numbers. I know it.
Mark, check out Sarah's question in the chat.
Yeah, so Sarah says, is it worth it to just have one investment property? Yes, for a couple of reasons. The ratios work flat, they just flat out work. So it is a good use of money regardless, but you have to start somewhere. Like for most people, you can't get to 10 units if you don't buy one. And conservative, patient use of capital in real estate allows you to grow that number over time. So I would say it's worth it for 2 reasons, Sarah. Number one is that one investment property can be profitable. Number two, one investment property helps you own 2 investment properties, which helps you own 4 investment properties, which helps you own 8 investment properties. And you don't have to build a massive billion-dollar portfolio to really generate good wealth creation. For a typical person in the United States, a 10 property portfolio can be life-changing. Owning 10 investment houses or pieces of real estate will legitimately change the financial outcome of most individuals in the United States. Yeah, Eric asked, is using cash as a purchasing power in the front end come into this equation? Yeah, great question. Under most market conditions, especially where we are right now, if you can acquire real estate in cash on the front end, it is to your advantage. And so what most like strong, savvy investors are doing right now is that they would likely purchase a property in cash and then very quickly do a cash out refinance to take advantage of leverage so they could go buy another one. Yeah. So it doesn't, to utilize leverage, you don't have to purchase a property using a mortgage. You could purchase a property using cash. Guys, what a lot of people do, I think this is a good, like balanced conservative approach. If you own your primary residence and you're like, you know what, I'm pretty risk adverse. I don't want to mess with being over leveraged. Focus in on paying off your mortgage on your primary residence. I haven't done this because I'm not risk adverse. I enjoy taking risk. I'm weird like that. But if I were to do this, you would pay off your primary residence mortgage and then go get a home equity line of credit. Say your house is worth $200,000 and you have no mortgage on it. You could probably pretty easily go get a home equity line of credit for $150,000 that you don't have to draw. So you're not paying interest on that money until you found the investment property that you wanted to buy. So you have $150,000 sitting there ready for you to use, but you don't have to pay interest on it. Go buy the investment property in cash for $100,000, refinance it, and pay your home equity line back down. I've seen people do this to build a nice portfolio of investment real estate and never have to be heavily leveraged, because at any one point in time, they either own an investment property with no debt or they own their primary residence with no debt. It's a really good conservative way to have that money ready without having to necessarily always sit there with $100,000 in a checking account, which sometimes can feel kind of silly. One last note on leverage. Leveraging real estate is it's what people would call liquidity without the liquidation. This is another unique aspect of real estate. Let's say you get later into life and you've built your wealth primarily using an IRA or equity investments in businesses. The only way in most of those types of investments to enjoy or utilize or spend that value is what? What do you have to do if those are the types of assets that you have used to build wealth? You own a bunch of stocks. What do you have to do to use that money? Letting y'all think for a moment. You have to sell the asset. Can't get the money out. Can't get cash. You cannot make that asset liquid to use it for something unless you sell the asset. Okay? Apple stock, you can't go borrow money against Apple stock. No offense to Apple stock. Real estate allows you to pull that lever up and down. If you own $1 million apartment building and you don't have any debt on it because you wanted to be conservative and you're content with the money that's making and you don't want to really feel like go out and buy anything else. And then all of a sudden, you want to pay for your nephew's college tuition. Like I want to be super generous. I want to just give my nephew $20,000. Well, if you own $1 million in Apple stock, the only way you can do that is you have to sell $20,000 of the Apple stock. Well, in your apartment building, just go borrow it. Just go borrow the $20,000 against the million. Really easy to do. So you have liquidity with no tax implications. You can go borrow the money. You don't have to pay taxes on borrowing money. With Apple stock, when you sell $20,000 of Apple stock, you don't own the asset anymore, and you had to pay taxes on the gain. If I haven't made your head spin, then great. If I did.
Mark, can you say that again? So for instance, I have, that $20,000 in equity. I can just go pull that out pretty easily, pay no taxes on it.
You don't have to pay taxes on it because you didn't sell anything. You borrowed money. You just said to a bank, give me $20,000 because I want to do something with the $20,000. And I will give you the security on that $20,000. You now have a lien for $20,000 against my real estate. You're going to have to start paying interest on it. But $1 million apartment building is generating plenty of income to cover that interest. So it's not just found money, it's liquidity. Real estate as an asset gives you more flexibility and options to utilize or enjoy the wealth that you've created than other forms of wealth do because of the concept of leverage.
Gotta say, that's pretty dope.
Mark, can I add one more thing?
Please add more than one.
So I have now 6 rentals in Broad Ripple that I started buying in 2015, and I got into real estate just like 2 years after that. So I've only been in real estate. This is only my 4th year. I have found my tenants to be an incredible source of referrals. And I have found my tenants to be an excellent source of buyers. So you throw one $10,000 commission into having tenants in your house for a year, and all of a sudden the rent that you're making or the value of the property going up and all of those other things and the tax things, that becomes 100 times better. It's just like, that's frosting on top. It's just be able to say that you're going to end up being able to sell a certain percentage of these tenants a house. And if you hand pick your tenants to those who drop into the conversation when you're interviewing them, well, we're moving here. My dad's, my husband's, going to be doing his residency here. And we think we may live here eventually and we're interested in buying a house, or we want to move here and just live here for a few months and because we're thinking of buying a house. Well, guess what? I'm going to do my best to make sure that we encourage that road.
And it's true, Sue, on the other end of the tenant relationship too, is that realtors, while it's not our like sweet spot, we do have the ability, we have an advantage in finding tenants.
Yeah.
Right? Like you can throw a property into the BLC. You don't have to pay a realtor to, like, if you choose to self-lease, you have more access to that. And there's the added value on the back end that you're referring to. I don't think Rex is on the call. This is the main reason that Rex Fisher became a realtor. So I don't know if you know that Rex and his family either own or manage several hundred units of residential rentals in the city. And he was like, I have all these like young professionals that they're probably what they're doing is they're renting until they pay off their student debt. And then they're going and buying houses. Like not all of them, but that's a pretty consistent pattern. You have to rent until your student debt is low enough where a bank will give you a mortgage. That's another story, but it's like, I should be working with these people as a realtor. So it's been a big source of business for him.
The other thing, just one other thing, is that I've been able to get some of the properties that I needed by waiving my commission. So in this market, that's just a huge selling point to say that they're not going to have to worry so much about appraisal. So I could take 10 grand off the value of the house. I'm waiving my appraisal. And I don't have to pay taxes on that money that would have been income for me. I'm getting the property over other buyers who don't have that option.
Yeah.
Puts me in a better position to actually get a house in this market. So.
Yeah, it's a different form of the value that you get for being a realtor.
Yep.
Right. It's like quantifiable competitive advantage, basically.
Yep. And you have to do the math sometimes because you say, hey, I'm offering you $10,000 less, but sometimes the seller hasn't even put together the math of what they would be paying me anyway. So it sounds like, well, I wouldn't have been paying you that much anyway. It's like, do the math, 3% of this is that amount. So,
right.
And you don't have to worry about it appraising.
Something else here that I'll throw in, and I want to wrap up here in a moment. But if you have any other questions, be thinking of those and we can hit them before we go. I do now, by the way, see that several of you were answering my question about how you get money from stocks. I was sitting here like, why does nobody answer that? Well, at least 3 of you did. So thank you. We talked about this in the business class. I think like, hey, let's just acknowledge it. When you talk about building wealth, it runs the risk of coming across as like, super money motivated or greedy, or that you're going to do this by exploiting people. We're talking about the fact that there's billionaires in the United States that basically don't pay income taxes because of the way that the laws are written. We probably have a problem with that. My philosophy on this is, if a certain industry is incredibly powerful and influential in the country, I hope that there's conscientious, community-minded people engaged in that industry and building wealth doing it. You saw that right now in the state of Indiana, the governor, I think it's accurate to say the governor actually just overrode or vetoed the stay on evictions. Maybe some of you have seen some stuff on social media about this. Essentially, that because of COVID, there's been laws nationally that protect tenants from being evicted if they can't pay rent because of the kind of extenuating circumstances. Not meaning to get into a conversation about that, but I've seen some people on social media today saying there's going to be a big problem in Indiana because the governor is essentially basically what he's doing is favoring landlords a bit in terms of saying, no, landlords in Indiana need to be able to evict someone now if they're not paying rent. Not going to have the conversation here in this setting as to which of those you philosophically believe. My point there is, if there's a high enough percentage of our population that would feel a conviction toward landlords being more conscientious to their tenants. If you think in Indiana laws are too favorable to landlords, FYI, Indiana has very landlord favorable laws nationwide in comparison to nationwide. If you think that, I would say all the more reason to invest in real estate, right? In your little pocket, in your community, in your neighborhood. One of the ways that you could engage in that is to be the owner, to build the wealth, to have that sort of influence and control, to where maybe the outcome of the wealth for you is that you can be the type of landlord that you want to exist. So there could be we could call that social capital. That I think this is one of the ways in which you could positively impact your community. We've talked about that building wealth. I think in our kind of modern Western context, building wealth gets associated with spending money. That's why you would build wealth. You build wealth to buy things. I say let go of that fake attachment. And I'm not criticizing spending money or buying things. I would have no grounds to criticize that. My point there is building wealth isn't necessarily just about yourself. Building wealth can have all sorts of motivating factors. And I think maybe philosophically, I'm a little bit frustrated as I look around the real estate landscape. The people that understand and utilize these principles the most generally do it for their own gain. That's a bit of a cynical approach. I don't think it's quite that all-encompassing. I would love for there to be more people who had kind of social community outlook and said, oh my gosh, I have all this expertise and am going to end up with all these financial resources. I have a means to impact my community by understanding these principles. I won't embarrass these people, but several of your coworkers do this. I bet you probably wouldn't know how much real estate activity there is in terms of ownership and investment that happens at Platt. And look, I'm not saying we're perfect individuals. We make mistakes. We do things that we shouldn't. But I think by and large, there's quite a few people here that have utilized these principles toward a positive, relational impact. I won't call them out because I didn't ask for their permission to do that, but I see that happening. And so I just would finish by saying, you might think to yourself, I don't need to bother learning these because I don't need to become rich. And I have a lot of respect for that. I really do. I might push back and say, yeah, but you have access and expertise. Maybe there's something else that you're going to have the opportunity to use the wealth for. And our city's going to be better for it. I really believe that. Okay. We didn't make it to 2:00. I know there's tons of stuff. I would encourage you to go back. Maybe you watch or listen to this again. Dive into some of the written resources that are out there, the hundreds, if not thousands of them. But I would just say, utilize your network. If it's me, great. If it's Rex, great. But I can assure you, if you have a question about investment real estate, particularly for your own purposes, you have a very valuable network here at Platt, and somebody can help. I'm not trying to set myself up here as the know-it-all. I'm not. Anytime I'm thinking about an acquisition, you better believe I ask more than one person about it. I utilize this network, so I hope the rest of you would feel comfortable doing that same thing. I know Crystal loves some Dave Ramsey, and I always end up criticizing Dave Ramsey in front of Crystal. I know. I really don't dislike his methodology. It has a good purpose. Guys, always feel free to reach out if there's anything else on this topic that you'd like to chat about. I do look forward to maybe at some point in the relatively near future hitting on this topic with some of you in person. Thanks for sticking through it. If we take out the 20 interesting minutes of conversation we had at the front end, We made it an hour and a half of non-interesting conversation. And so for those of you who are still here, I commend you. Rosie, any closing words?
Not really. Next month we have some folks from my board come to tell us about all the stuff that we do wrong. So please join us. And then April, our very own Crystal White's going to be speaking. So hope you guys can continue to make it to these. Maybe one day they'll be in person. Have a great day, everyone. Stay safe in the snow.